Welcome to the InterMarket Analysis update. This is a weekly video that I prepare using daily charts just to show how different markets interact with each other. We mainly focus on the stock market, but we also look at the bond market, commodities, gold, a lot of different things just to see if we can get any insight from looking at different markets. This is being prepared July 25th, and it will cover the week. So let's go back and look at, first of all, valuation within the S&P 500. This uses the trailing 12 months. This looks backwards. These are numbers that have been published. And when you have the S&P in black up here, when it's above this red line, that means that we are overvalued. When we're down at the blue line, that means we're fairly valued. When we get down to the green line, that means that we are undervalued or considered cheap at that point. We have been expensive for a long time. Well, with the declines that we've been seeing in 2022, the S&P has been coming down, and we're still playing with the top part of the being expensive measurement of the S&P 500. Now, if you look forward at forward earnings and estimates, those are just guesses. Those are forecasts, but that's what the market uses to justify having either higher or lower prices. This chart will look different. Generally, the look forward numbers are higher than what has actually been reported. Down below, we have a distance measurement between the S&P 500 and this red line, where we were very overvalued. We've come down and we're right about okay when it comes to the expensive level based on the PE ratio. This next chart is just a historical chart showing you how the market has behaved and when we've been considered to be overvalued, undervalued, or fairly valued, and what the market has done after that. Now, these conditions can exist for a long time. So just because we're overvalued doesn't necessarily mean you have to do everything right now. It's just something to be aware of. If we're undervalued, we can stay undervalued for an extended period of time. Doesn't mean you have to act right away. You're just aware of these things happening. The first thing I want to talk about is the possible positive scenario. These are things that I discuss in the daily charts and in the daily videos. And please feel free to look at those if you would like. But we have a number of possible positive setups. These are not buy signals. These are just things that we're looking at saying, okay, this looks like positive. The market could go up based on what we're seeing right now and based on what has happened before in the past. This first one is the percent of stocks that are above their 200-day simple moving average. And a lot of times when we come down and give an extreme negative reading, that has marked a low in the S&P. That's why I have this chart up above. Well, we came down almost and set an extreme negative reading, and we've been bouncing up ever since then. And you're going to see a lot of different charts that I bring up that show the same kind of pattern. This next one is the 10-day average of the S&P 500 highs and lows. So we take the highs and lows and then take a 10-day average of that. We've also given a recent negative reading, and we've been bouncing up out of that. Now, I will tell you, in the daily videos, I made mention of this. We're not seeing a real strength right now as I record this with the highs and lows. We saw a positive week last week, except for Friday. And the market's really been improving quite a bit, but we're not necessarily seeing that with the highs and lows. That's why this indicator is not really bouncing up higher than what it is right now. The next thing is the equity put call ratio. There's the 1-day chart that I show. Well, this is a 5-day simple moving average of the 1-day equity put call ratio. When we spike up, that means that we've gone extreme negative. You have to use this kind of counterintuitively, because when this is spiking up, that means we've been going down. And you can look at other times when we have spiked up, that often marks a low or near a low in the S&P 500. We're still working off of this spike right now. And right where I have this highlighted is the current value. Another thing that looks even a little bit more positive is that we have sector rotation going on. And this is more intermarket analysis, where at the end of 2021, we saw the S&P going higher, but we saw the ratio between the QQQs, which are mainly growth stocks, and the SPY they were showing a negative divergence. So we had growth stocks that were being sold at that time and value stocks that were being bought. We also saw that with discretionary and SPY. These are more growth oriented things that you would like to have, but the first things that you often do without when the economy starts having trouble. We also saw growth really declining on a ratio basis with the value stocks. Well, what we've been seeing over the last few weeks is just the exact opposite here. We're seeing where the Qs are starting to outperform the SPY, and it's continuing to go up, and that is still hanging in there. We see discretionary. Even with the down day on Friday, discretionary advanced slightly. So they're starting to outperform, and growth against value, even though it declined a bit on Friday, is still outperforming. It's still above the moving average. So what we're seeing based on these charts is where at the beginning of the year, the smart money had been getting out of growth and getting into value. We're seeing just the opposite of that now. They're getting out of value and getting back into growth. When they're in growth stocks, that's when we see the really nice run-ups with the S&P 500. Here's another chart showing the growth and value ratios with the large caps, mid caps, and small caps. And even though we declined a bit on Friday, we're still outperforming overall. Another thing that we look at is the 2-year Treasury yield. When this spikes up and goes down, this often marks a short to intermediate term bottom in the S&P 500. And you can see what happened with the chart up above. We have spiked up and we're coming down, but we don't really know if this is a spike at the time. We came back down quite a bit, but then on Friday we bounced back up because the S&P declined on that day. So we want to just keep an eye on this as well. The staples sector, this is another thing to really watch. It had really been going higher throughout 2020, 2021, and even through a lot of 2022. Well, we're seeing the blue line now crossing below the red line, and this is a death cross. We're seeing a real conglomeration of price right here, and you can't quite see that, but the blue line is now below the red line. So this is something we haven't seen in a few years. So these are staples. These are things that you have to get even when the economy is not doing very well. Well, it looks, according to this chart, that maybe that is starting to wear off a bit. Now, from that, we get another chart where we take the staples that we just looked at in the S&P and we make a ratio between the two. When we have a spike up and it comes back down, this often marks a pretty significant low in the S&P 500. We have spiked up here, way over on the right-hand side. We're coming back down, even though we bounced up a little bit. The thing is, we don't really know if this is a valid spike or not. For a long time, we were working off of this spike here, thinking, okay, here we go. This is going to go higher. We did not see that really confirmed by price. It bumped up a little bit, only to come back down. So we know this a little bit better in hindsight, but we just want to keep an eye on this, knowing that this is on the table, something that we can look at. And if we see it confirmed by price actually going higher, that will bode well for the S&P 500. Looking at growth versus value, we take a number of different measurements. This is just growth all by itself. And the red line is a 200 period moving average. The blue line is a 50 period. And we are below the 200 period, and we're starting to bounce back up a little bit. So where we had been more negative, we're seeing some improvement now. Now we look at the value index, where we've just seen a recent death cross here, and price is below both of the moving averages. So what had been pretty strong for a lot of 2022 is now turning over into a negative trend. We compare the two. Here's growth versus value, where it had really been underperforming. It was down on Friday, but it does look like it's improving overall. An inverse chart of that is that value had been really doing well, but has since seen some weakness, even though it's still in an overall uptrend. Here's another index looking at growth and value, where growth had been doing quite well, but lately we've been seeing a bit of a bounce after having seen a death cross for most of 2022. This next chart is just an inversion of that previous chart, where value is still in an overall uptrend, but it is showing a lot of weakness right now. Here's another look, growth versus value, just showing where growth had been in a downtrend, but is starting to bounce back up. An inverse of that shows that value has really been outperforming, but now starting to show some weakness. This is another thing. And I look at lots of these charts, not just to say I'm seeing the same thing over and over, but sometimes you get some different insight by looking at a lot of different charts and a little bit of a different look. You can see something that maybe you had not seen before, where the growth index is still in an overall downtrend, but starting to bounce. All right, let's look at some other markets. We have the 30 biggest US software companies. They've been in an overall downtrend, but lately they're starting to bounce up a bit. Can that continue? This is looking at inflation, where this was developed by Martin Pring, where we have the CRB on a monthly basis, still in a pretty solid uptrend, even though it's showing some weakness. Down below, we have those inflationary stocks against deflationary stocks, and we see where inflation has really been coming down lately. And that kind of goes with what we're seeing in the bond market. We're seeing bond rates start to go up slightly and interest rates start to come down. Here's the CRB index all by itself, where we're still in an overall uptrend, but we have shown some real weakness lately. Corn, here's another thing that had spiked up and is now starting to come back down. Aluminum spiked up, starting to come back down, and pretty kind of a nasty quick fall there. Here's heating oil, where it had started to come down. It's still pretty high, but it's well off of the highs that it had been giving. Here's gas, where it really spiked up and now is starting to come back down here. Natural gas, this one's a little kind of baffling because we spiked up, really came down, and now we're starting to go back up again, which it's the middle of summer. So I don't know. I think of natural gas as being used in houses, but it's probably had some different uses. Oil had been well over 100 for quite a while. Now we're down below 95 at 94.70. Here's wheat, which had spiked up and is starting to come back down. Lumber, which had been bouncing up, is now also starting to come back down. The US dollar, which has been really strong. Now, if we start to see stocks really go up, if they really, the S&P 500 continues to advance, it is very likely that you're going to see the dollar start to come down. But we're still in an overall trend for right now, even though the dollar's shown some recent weakness. Here's the dollar against the euro, where the euro has been pretty weak. The dollar has been pretty strong. They're kind of battling back and forth as to which one is in the lead right now. This looks at the Japanese yen, which they have a lot of problems right now in Japan economically, and it's coming through to their currency, where we're seeing some weakness. Here's the euro showing weakness. Here's the dollar showing some strength. Here's copper, another thing that we look at to kind of get a gauge of what's happening economically. When copper is going up, that means the economy is looking better. When copper starts to go down, that sometimes can be a leading indicator of what's happening in the economy, and it's really dropped off. And I have another chart here. I don't have a label on this, but it's the copper to gold ratio. And gold has been really having a lot of trouble, and so has copper. So they both have been falling and kind of bouncing around recently. Here's another look at that same chart. The black line is the same chart we just looked at, and then we have the 2-year yield in green. Usually these don't get too far apart from each other. Right now, they are far apart. So what's going to happen? Is the gold copper ratio, is that going to improve, or are interest rates going to come down? We're kind of watching that played out day by day. Here's gold showing that we've really been in a downtrend now. It tried to bounce up on Friday, but then ended up closing near the lows for the session. And then silver has really been having trouble as well. It's in a downtrend also. Some of our index ratios. Here's the CRB index, which is inflation and the commodities against the S&P 500. Well, for a long time, it had been underperforming. In 2021 and into 2022, it was outperforming, but now we're seeing some relative weakness here. Here's an inverse of that same chart, showing that the S&P 500 had been outperforming and has been in a downtrend, but is possibly looking to bounce. Here we have the NASDAQ 100, which are growth stocks, against the S&P 500. Well, the NASDAQ 100, even though it's still in an overall downtrend, it has shown some improvement, but we did see a decline on Friday. Here's the mega cap growth. These are the real big companies: Apple, Google, Facebook. the big stocks that everybody loves to get in and out of and talk about, where they overall had been in a real downtrend, but they could be starting to bounce, even though they were down on Friday. The S&P 100, which is more growth oriented, against the S&P 500, also still in a downtrend, but really showing some improvement. Here's small caps. There's some articles that I've been reading that suggest that small caps are really undervalued right now. And if people start to get into those, that could really bump up small caps, which could help the overall market. Well, they've been in a downtrend overall, but lately have been starting to bounce a little bit. What we have here is another signal that we use where when we see a little spike up on this red chart here, that is a ratio between small caps and the S&P. And then the blue chart, or the blue line here, is the S&P itself. Sometimes when this spikes up, not long after that, we see a spike up in the S&P. But we've seen that before, only to have it fizzle out. So we want to keep an eye on that. The low volatility stocks. These are the stocks that folks get into when the market starts to have some trouble. It's had a recent death cross and is below both moving averages and kind of hanging out right here. Will they continue to fall after having been in a pretty solid uptrend? Here's the ratio, the S&P low volatility stocks to the SPY, where it shows low volatility stocks had really underperformed until we got into 2022, where they outperformed, and they're still in an uptrend overall, but showing some recent weakness. Here's the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together, showing some improvement, but still in an overall downtrend. Here are the three indexes with no studies on them. Here's the S&P on the top, the mid caps, and then the small caps. And we like to see them generally going in the same direction, which they tend to do overall. Here's the thing called Dow theory, where we look at the Dow Jones Industrial Average and then the transports, and are they tending to move in the same direction? And then I add the utilities, where they're kind of going down a little bit more. And this may not be part of Dow theory for somebody who's used this for a long time, but other folks think that this can really give us some insight. So we're starting to see utilities, even though they bounced recently, they seem to be having some trouble lately. Here's a longer look. And what we tend to look for are divergences and convergences, either positive or negative. But these sometimes can fool you. If you look back here, back in 2015, 2016, we saw the Dow making higher highs, but that was not confirmed by the transports. But look at what happened afterwards. So a lot of folks use this to go, wow, look at this divergence here, only to see it not really play out that way. And then at the bottom are utilities and how they've been performing. Here are the FANG stocks. These are the big ones: the Facebook, the Amazon, Apple, Netflix, Google. And I think there's even some other ones in there. They might have to get to the point where they change the acronym, but they ended up being down on Friday, but could potentially be seeing some kind of a bounce, but they are still in a downtrend. Looking at bonds versus stocks. This is the total bond ETF, and it's just showing a little bit of a bounce here where we're not really falling down like we were before, but we have a long ways to go to get back to an uptrend. Here's the World Bond Index, which they're going down and testing back to the COVID lows. It looks like a little bit of a base could be forming here. Can we begin to bounce up? What would be nice would be to see bonds go up and stocks go up together, where lately, the last few years anyway, they've been going in opposite directions. Because if bonds go up, that means interest rates are coming down. But we need to see that for more than just a few days. We need to see the long-term trend change to that. Here's the stock versus bond ratio on a monthly chart, where stocks are outperforming bonds slightly. We had a bit of a breakout here, and then it went up and it's come back down. Are we going to drop below this moving average? That would signal that there's some real weakness coming into stocks, and now some strength might be going back into bonds. Here's another chart showing bonds first against stocks, where we're trying to break out. We've just had a recent golden cross here, and we're still above the moving averages, but we want to see this follow through continue if bonds are going to start to improve. We do have a couple of yield curves that are inverted. The 10-year to the 5-year is currently negative right now, and this is not all that important for the 10 to the 5. But when you have an inverted yield curve, that can suggest a recession may be lingering in the future. This is the one that people really pay attention to, the 10-year to the 2-year, where we have gone negative and we continue to fall. Another one that we want to watch, it's not negative yet. It's the 10-year to the 3-month yield curve. And if we go down into this red area, you'll have a lot of economists who said, no, we're not going to go into a recession. Well, they might change their tune if we do continue to drop with this yield curve. We look at the bond index. This is the price of corporate bonds, where they have been bouncing lately, but they're still in an overall downtrend. Then we look at the S&P 500 to the 10-year yield, where the S&P has really been underperforming, but it's starting to bounce, but we're still in an overall downtrend. We also want to keep an eye on junk bonds. Sometimes folks need to get into junk bonds to get a better yield because they're not getting much with treasuries. They're not really getting much in the stock market. The dividends may not be paying them what they like. So then they take on riskier investments. They're in an overall downtrend as well, but could be starting to bounce. Then we have a ratio between junk bonds and treasury bonds, where treasury bonds have been underperforming or junk bonds have been outperforming, but we're starting to see a little bit of an improvement here. Then we look at the different yields. Here's the 30, 10, 5, 2, and 3-month yield. And this is interesting because in a high inflationary environment, these yields should be going up to match inflation. But no, overall, they're coming down. So we want to keep a close eye on this as well. Then we look internationally, where we're seeing the same thing. The US, the UK, and Germany, they're seeing a recent decline in rates, where they're having a lot more problems in Japan right now, and that's why they're keeping their interest rates flat. Looking at some of the different sectors, here's the energy sector, which has just been the place to be in 2022. Well, lately it's been really underperforming. Then we look at the tech sector, which is still in a downtrend, but could be starting to show some improvement. And then we look at semiconductors, which is a huge part of the tech sector, also in a downtrend, but looking a little bit better. The tech sector to the S&P, both have really struggled in 2022, but now the tech sector is looking a little better. If we want to get back into growth type investments where we see the market really go up, the tech sector will have to improve. Some other areas, here's growth against bonds, two areas that have really suffered in 2022. They're coming right up to this longer term moving average and coming back down a little bit, but at least they're going sideways instead of really going down. But these are two areas that just have not done very well. The 10-year has been really strong in 2022, but now could be starting to show some weakness relative to the tech sector. Here's the tech sector relative to the 10-year, just an inverse of the chart we looked at, where the tech sector had been really underperforming, still in a downtrend, but could be showing some improvement. Here's discretionary, the things you would like to have against the staples, the things you have to have. It had been in a strong downtrend, and it still is, but it could be starting to show some improvement. Here's just an inverse, the staples against discretionary, where staples have been outperforming, and now we're seeing some weakness. And remember that their sector has now turned negative. Here's energy, the place to be in 2022 against tech, the place to be a couple of years ago, where energy has been really outperforming, but has shown some recent weakness. Here's gold. A lot of people like the gold to S&P 500 ratio. Gold has been really having trouble, and the S&P has been having trouble. Gold has been outperforming on a relative basis, but is now coming down to this lower moving average. Are we going to see this eventually roll over and turn into a death cross? Here's gold to the dollar. This continues to really fall because the dollar's been doing well and gold has been not doing well. So that's why we see this ratio going down. The high leverage loans, these are the more risky loans. When they're really going down, that could be pretty negative for the market. Well, we're seeing a bit of an improvement, even though they are in a downtrend. Here's InterMarket Analysis, going back to the beginning of the year, showing that oil is still up over 35%. And then what's in second place is the dollar, where you have gold, stocks, and bonds are negative since the beginning of the year. Looking at some different indexes, here's the S&P 500 just all by itself with its 50-period moving averages. we had an extreme negative reading and are continuing to bounce. And then we look at the mid caps, extreme negative and bouncing, and then the small caps, extreme negative and bouncing. So we're seeing this across the board. These are confirming each other. And if you go back to this S&P chart, look, when we had this kind of an extreme negative reading, sometimes that would mark a pretty significant bottom in the S&P 500. All right, then we have the small cap index all by itself, where it's coming back over the 50-period moving average, and we're above this pivot level. That is looking okay. Can it continue to improve, or are we going to fall back down? Then we look at the mid caps, also looking better. Can it stay above the moving average and the pivot level? The Dow, above the moving average and above the pivot level. Where the NASDAQ, it's been kind of leading, but we had some overhead resistance. It's above the moving average and above the pivot level, but it went up to R1 and hit some resistance there and has been coming back down. Can we break through this? Because we're dealing with some gaps here, not only in the NASDAQ, but also in the S&P and the Dow. If we could break above these gaps, that could be very positive for the market. The NASDAQ 100, this is the 100 biggest stocks in the NASDAQ, coming up to this resistance level and now coming back down. Can it break above that? Here's the Wilshire, a broader measure where we're above the moving average and still below the resistance level. Here's ARK. This is the ETF that a lot of people are in love with and a lot of people just sank a lot of money into. It's really been suffering in 2022, and it's really been suffering since its all-time high. Can it start to bounce and get back on an uptrend? Currently, it's still in a downtrend. Here's all stocks, both in the US and international. We're coming back slightly above this moving average, even though we declined on Friday. Emerging markets. A lot of people like to invest in the ETF EEM, where we're in an overall downtrend, and it's really not really showing too much of an improvement right now. Internationally, China is in a downtrend right now. Emerging markets continue to be in a downtrend, where Europe, Japan, and the US continue to be in an uptrend when looking at this indicator. Some correlations just to see how things are behaving with each other, and I've tried to include some lines on here. We have the dollar to the S&P 500, and they're tending to go in the opposite direction. So at least for right now, if the dollar is going up, stocks might be going down, and the inverse of that is also true. We also have oil to the S&P 500. When it comes below 0.25 or above minus 0.25, that's when I consider it to be neutral. So we're not really getting much from that. We're also neutral with the S&P to the 10-year yield correlation, and we continue to be neutral with the tech sector against the 10-year yield. And here's the S&P to the 2-year yield, also pretty much neutral right now. So what are some things that are positive? Energy, CRB, gold, but it is showing some weakness now. And interest rates, they're still in an overall uptrend, even though a lot of these areas have shown some recent weakness. Then we have the negative areas, and this is a pretty long list. And I won't read this off to you. I'll just let this sit here for just a minute, where we've had a new addition to this, the staples. They're added to the very bottom, but a lot of the growth sector, a lot of the stocks, a lot of the things that most people really like to invest in, they continue to be in downtrends, even though we are seeing some improvement. So thank you. I hope you have a wonderful week. Please feel free to check out the daily and weekly videos that I also post, and I hope you find this helpful.